In 1989, this was the most envied stock market on earth. Japan. At its very top, it was worth more than any market in history. It was the future, everyone said. But then it fell. Not for a year, not for a decade. It stayed below that 1989 peak for 34 years. It was a whole career spent underwater. Most of us invest on one quiet belief: hold on long enough and the market always comes back. And usually it does. In 2008, the S&P fell almost 60%. A few years later, it was setting new record highs. But Japan is where that belief broke. So it's worth asking three questions we usually skip. Why does the market go up at all? Can we really count on it? And is the American market normal? Or did we just get lucky? To understand the fear, you have to understand the confidence. In the 80s, Japan wasn't the underdog. It was the future. It was beating America at cars, at electronics, at manufacturing. Japanese firms were buying up American companies: Rockefeller Center, Pebble Beach, Columbia Pictures. Books predicted Japan would run the next century. And at the peak, Japan was the single biggest stock market on earth. 45% of the entire planet's value, from a country with half of America's population. Now, sit with that for a second. The way we talk about the American market today, that it always comes back and that it's safe, is almost word for word how the world talked about Japan in 1989. It was the same confidence, the same certainty, and lately some of the same sky-high prices. One of them was wrong for 34 years. So the real question isn't whether markets go up, it's whether the American market is truly different, or is it just the one everyone believes in right now? To answer these questions, we have to first answer another one. Why does the market go up at all? It's not magic, it's arithmetic. Your return comes from exactly three things. First, dividends. Real companies earn real cash and they hand some of it back to you. Historically, that's about 4% a year. Second, growth. The same companies earn more over time. Let's call it 5% a year. And that 5% is really just two things: inflation, which is around 3%, and real growth of about 2%. This is the world generally producing more each year. So let's add it up. Dividends about 4%, growth about 5%, and the third factor, which is valuation. What people will pay for $1 of earnings averages out to roughly nothing over time. That's 9, maybe 10% a year. Take out inflation and you're left with around 7% of real returns. 7% doesn't sound like much, but it means your buying power doubles about every decade, again and again and again. But there's just one assumption holding all of this up: that we keep producing more, but profits can't outgrow the whole economy forever. And yet, individual companies don't last forever. They rise, they fade, and some die completely. So why doesn't the whole market die with them? Here's the trick. An index isn't a fixed list of companies. Each one is weighted by its market capitalization. So when one fades, Kodak, Sears, Lehman, it quietly shrinks out and the winners take its place. Apple, Microsoft, Nvidia. It swaps losers for winners without you lifting a finger. A single stock can go to zero, but for a whole index to go to zero, every company in it would have to fail at once, which makes the case of Japan even stranger. If an index cleans itself like that, how did a country full of great companies go nowhere for 34 years? Two things broke Japan, and they can break any market. The first is price. By 1989, Japanese stocks were the most expensive in history. Investors were paying 60 times earnings, 3 to 4 times what a normal market pays. It got absurd. At the peak, the land under the Imperial Palace in Tokyo was supposedly worth more than all of California. The companies were fine. The price was insane, and if you overpay, even a great business can be a terrible investment. And this isn't just history. Look at the American market right now. Some of the most valuable companies on earth are being priced in a future that hasn't arrived yet. A whole wave of AI companies carry enormous valuations while earning barely any profit, and some none at all. Investors aren't really paying for what these businesses make today. They're paying for a story about what they might make tomorrow. That story could absolutely come true, but it's the same bet Japan made in 1989, that the future was so certain almost any price was worth paying. Sometimes it works out, sometimes you spend a decade finding out it didn't. The second thing is survivorship. That beautiful chart of stocks always rising for 200 years, that's the American market, because America won. Other markets didn't. Russia, 1979, investors wiped out completely. China, 1949, the same, straight to zero. Those markets aren't quietly dragging down the average, they're not in the average at all, they're just gone. So the chart of triumph is really a chart of survivors, which makes you wonder, is America the rule, or is it the single luckiest one of them all? So here's the honest answer, and part of that answer is yes. The US got lucky, and no single market is promised to you forever. But even Japan isn't quite the horror story it looks like. Picture two investors. The first put everything in at the 1989 peak, the worst possible moment. 35 years later, they'd only just broken even. The second did something ordinary. They bought a little every month straight through the decline, and because prices kept falling, that same money bought more and more shares for a lesser price. By today, the second investor has a return of about 250% on their money. A market that falls and stays down isn't only a disaster. If you're still buying, it's a long, quiet sale. Which brings us to what actually protects you, and this might be one of the safest investments you can make. You don't have to pick the winner. You can't buy every market on earth yourself, but you don't need to. One global index fund holds nearly all of them in a single purchase. It's the whole world in one fund. The US, Japan, the UK, China, everywhere else, each weighted by its real size. And it rebalances between entire countries on its own. If America fades and somewhere else rises, the fund quietly follows. No decision required from you. Today, it's still about 60% US because the US really is the biggest right now. But that number isn't fixed, it moves with reality. So, will it go up forever? For any single market, honestly, it's hard to say. Japan went flat for a generation. Russia and China went to zero. There's no law that says the American market has to recover every time. But zoom out and it steadies. The whole world's market rises for a reason you can actually write down. Dividends plus earnings that grow as the world produces more, plus a reward for your patience for holding through drawdowns and taking on risk. It's not magic, it's not owed to you, but it's about as durable as anything in finance gets, as long as people somewhere keep building, keep innovating, and keep producing. So when you buy the whole market, you're not really betting on a line going up. You're betting on people everywhere continuing to build. And there are only a few ways to lose that bet. Don't overpay when everyone's euphoric. Spread across the whole world, keep buying through the bad years, and give it time, measured in decades, not months. Do that and the odds are extraordinarily in your favor. Because in the end, even Japan came back. You just have to be able to afford to wait. This is Candle HQ, and if you enjoyed this video, then please make sure to like and subscribe. Thank you and see you in the next one.